Welcome back. In this video, I will discuss the bull call spread and the bull put spread. These are two option strategies, that is, they involve trading two options simultaneously. Both these spreads are employed when you have a bullish outlook on the price, which is why the name of these spreads is bull call spread and bull put spread. Now let's look at these one by one, and I will also discuss which spread should be used when. First, let's start with the bull call spread. This spread involves buying a call option and selling a call option of higher strike. For example, on the right, you see we bought the Reliance call of 2200 strike and sold the Reliance call of 2300 strike. Both these options have the same time to expiry because they both expire on 25th March. One leg of this strategy involves a long call position, while the other leg of this strategy has a short call position. By taking these two trades simultaneously, we create what we call a bull call spread. You can buy this spread when you have a bullish outlook on price of the underlying security. The natural question you might have is, how do you select the strike price for the call options of this strategy? Now this depends on your view on the market and also a little bit on your risk appetite. Let's say you have this view on Reliance. You want to go long around current price of 2175 for a target price of 2300 and a stop loss of 2100. In this case, you can buy a call for a strike closest to the current market price, provided there is enough liquidity for that strike price. So for example, the 2200 strike call option is pretty liquid in case of Reliance, and it is also the nearest strike to the current market price, so we can go along the 2200 strike call option. This will be the first leg of our bull call spread. For the second leg, we can sell a call option with a strike close to the target price around 2300, provided there is enough liquidity for that strike price. In case of Reliance, the 2300 call option is liquid, so we can sell the call option of this strike. So by buying the 2200 call and selling the 2300 call, we have created a bull call spread. Since the strike price of 2200 call is closer to the current market price than the strike price of 2300 call, so the 2200 call is going to be more expensive than the 2300 call. So you will need to pay to buy the 2200 call and you will receive a premium for selling the 2300 call. Here you see that the 2200 call is available for 66.5, while the 2300 call is available for 33.55. Since you buy the 2200 call and sell the 2300 call, there will be a net outflow from your account in order to initiate this strategy. In this case, you will be paying a net premium of 8,238 rupees, which is the difference between the price of the two calls multiplied by the lot size for Reliance, which is around 250. Now let's look at the payoff diagram here. The dashed line represents the payoff for the trade if you hold the trade to expiry. In this scenario, your maximum profit will be between 16,000 and 17,000, and the maximum loss possible is the net premium paid by you, which is around 8,238. However, if your stop loss or take profit is hit on the same day as the day on which you took the trade, then your payoff is represented by the solid line here. What this means is that if the trade immediately hits the target price, then the profit you earn on closing the position on the same day would be lesser than what it would have been if the target price was hit on the day the option expires. Similarly, if the trade immediately hit the stop loss price, then your loss on closing the trade today itself would be lesser than what it would have been if the stop was hit on the day these options expire. So as the days pass without either your stop loss or target price getting hit, your potential profit on the trade increases, while the loss on your trade also increases. If your stop loss or target price gets hit on the expiry day, then you will see the maximum loss or maximum profit as indicated by the dashed line here. Next, let's look at another type of spread that can be used if you are bullish. This is known as the bull put spread. A bull put spread consists of selling a put option and buying a put option of lower strike. Both these options have the same time to expiry. On the right here, we have constructed a bull put spread by selling the 2100 strike put and buying the 2000 strike put. Both options will expire on the same day, that is March 25th. When you sell a put option and simultaneously buy a put option of lower strike, you execute what is known as a bull put strategy. Now let's look at how we can select the strike price for a bull put strategy. Let's say here is your outlook for Reliance. The current price is 21.75. You expect it to move to target price of 2300, and also you decide that your stop loss for this trade is around 2100. Now in order to create a bull put spread, you sell the put option with the strike which is closest to your stop loss price. You need to make sure that this strike option is liquid so that you can easily enter and exit the trade. For the other leg of the bull put spread, you buy the put option of a strike that can limit your loss to a reasonable level. In this case, we have bought the 2000 put option. Let's see the payoff diagram to understand the risk and return when we take the trade with this strike selection. Here we see that the 2100 strike is available for 41.5, while the 2000 strike put is available for 17.2 rupees. When you sell the 2100 strike put, you will receive a premium of 41.5, and when you buy the 2000 strike put, you will pay 17.2 rupees. This means you will net around 24.3 rupees. When you multiply this to the lot size of around 250, you come to the amount shown here. So when you initiate your trade at these prices, you will receive around 6000 rupees for each lot. The dashed line here shows the payoff if you hold this trade till expiry. In case of this trade, if the prices stay above your stop loss of 2100 on the expiry day, then you will actually make a profit of around 6000. To lose on this trade on the expiry day, the prices will need to go below 2076 level, which is basically the strike price for which you sold the put, minus the total premium received of around 24 rupees. Since our stop loss is 2100 and since we sold the 2100 strike put, we will end up with some profit if the stop loss price is hit on the expiry day. However, if the prices hit the stop loss price today itself, let's say you initiated the trade today and the stop loss price gets triggered today itself, then your payoff will be decided by the solid line shown here. So if the stop loss price gets hit today itself, then you will lose around 4000 rupees on this trade. Similarly, if your take profit price of 2300 gets hit today itself, then you will make around 4000 rupees. If however, neither your stop loss or take profit is hit, then as the days pass, this solid line curve will converge to the dashed line. As days pass, what will happen is you will accumulate theta because of the short put position, while you lose some theta because of the long put position. Since your short put position is of higher value, you accumulate more theta due to this leg than the theta you will lose because of your long put position. On balance, you end up accumulating theta each day if the prices stay above your stop loss price, which results in this solid line curve slowly converging to the dashed line curve over time as the expiry nears. Now let's understand when should you be using which strategy. Both the bull call spread and the bull put spread are useful when you are bullish on the market. However, there are times when you should prefer one of these spreads over the other, and the primary consideration for this should be your time to expiry. It is best to deploy the bull call spread when you have at least 3 to 4 weeks remaining to expiry. This is because when you execute a bull call spread, you are paying a net premium. This premium is basically the time value of the options involved, which means every day you hold this position, you will be losing some theta, and this theta decay would be quicker if the time to expiry is less. Conversely, this theta decay will be slow if there is at least 3 to 4 weeks remaining to expiry. For this reason, you should initiate a bull call spread when you have at least 3 to 4 weeks remaining to expiry. Conversely, when you are 2 to 3 weeks or less away from expiry, then the theta decay accelerates. When you initiate a bull put spread, you will be receiving some premium. In this scenario, theta decay would work in your favor as short put option will start losing value faster compared to your long put option position. In this scenario, it becomes better to execute a bull put position as such a position gains value rapidly every day due to theta decay. So for example, if you are going to initiate your trade on the 1st of March, you should execute a bull call spread because you still have more than 3 weeks to expiry. Conversely, if you are going to take a position say on the 9th of March, then you should execute a bull put spread because you have less than 3 weeks remaining to expiry, and so theta will be very strongly in your favor during this time. Another secondary factor you might consider is volatility. Generally, when volatility is low, the option premiums are lower, which means executing a bull call spread will be cheaper as the premium of call options involved would be lesser. So the best time to buy a bull call spread is when the volatility is low. Conversely, when the volatility is high, you can execute the bull put spread as the option premiums will be higher and you will receive higher premium if you execute a bull put spread. So for example, if the IV percentile for the stock is less than 40%, then the volatility is low compared to the historical volatility in this scenario, so it's better to go with a bull call spread. Similarly, if your IV percentile is greater than 60%, it means that the volatility is relatively high, so it's better to go with the bull put spread. I would suggest keeping volatility as a secondary factor and primarily choose your strategy based on time to expiry, because theta decay is usually a more potent factor for short-term trading.